All right, with the market trading at session lows, it's a perfect time to bring in Tech Trader and see how low we may go. What's up, Sean?
Good morning, correction.
Is that my new name?
No, it just sort of felt right, to say good morning, correction, because it's long overdue. I don't know. You just asked the question. I'm not sure how low we go. I mean, what I say last time, 300 to 400 Nasdaqs is probably something in that range. We've probably done 200 already.
Well, 150 today. Well, at least in the futures, so.
I mean, 4 of the last 5 days are down. 3 of those down days have been pretty minor. We're down about 150 right now. So we're probably 200, 225 off the lows. I mean, the thing is, we had a big Friday update that was just weird. But this is a weird market. I mean, this is a very weird market, and we could talk about the relative weirdness of the market. But yeah, I mean, it's getting up there in the strange category, kind of semi-historic proportions, just in the fact that valuations alone. And again, this is not 99. This is just the most expensive that expensive stocks have been since 99. And 99, I don't know if they were the most expensive all time, because I don't have the valuation ratios, price sales ratios, EBITDA ratios. Did they even calculate EBITDA in 1929 or 1930? They certainly had price sales metrics, and they had price to earnings metrics. So my guess is 29 was more expensive. Some stocks got exceedingly expensive in the 1970s too. That 1970s sort of mini bubble, the Nifty 50 bubble. I've heard stats like 5% growers were trading at 50 PEs and things like that. Again, I think 99, aside from 1929, it's either 99 was either the most expensive or the second most expensive, especially for the most expensive stocks. I mean, you had, again, Cisco Systems, which was at the time, I think it might have been the largest market cap stock in the world. If not, maybe GE was back then. It was one of the top 3. And, a very large cap company was trading at 45 times sales. I mean, we don't have, that would be like CRM trading at 45 times sales today. So the magnitude of the reach of 99, we aren't even close to. But I do think, look, if it's the most expensive since 99, it's damn expensive. Sometimes, you don't need to overthink that.
All right, but if you're just talking another, 200 to 300 Nasdaq points, that's not that big of a correction, all things considered.
Well, but you don't. This is kind of market cycles. You don't typically get. You usually don't get the biggest correction or a crash. I've said I don't think we've hit. I don't think we've put in ultimate highs for the year. Although I said that more in February and March. Those calls were 100% right. I definitely don't think we hit. I don't know though. I still don't think we've hit ultimate highs for the year. I guess I gotta digest this 8176 number on the Nasdaq, because it's possible 3 weeks or 6 weeks from now, I might think 8176 could be, could be the high for the year. I still don't think so though. I think there's more room. I mean, we haven't seen the small caps rally at all. We haven't seen value stocks rally at all. I mean, there's literally hundreds of stocks that could soak up a massive amount of market cap. It's again, the state of the market right now is almost identical to when I called the biggest of the third corrections last year, and I hit every correction last year right on the nose. And I said the third correction would be the most severe, and it was. Just so, like I say, I don't think the first correction this year is going to be the most severe correction. But the state of the market is the same. It's very thin. The rally didn't start out as thin, by the way. And I mean, in January, we had the mother of all January effect moves. Cheap stocks actually participated very well. Value stocks participated very well. So the market was very the rise off of those incredible December lows, I felt, was very rational. probably into about late to mid-March, and then it just became, all about cloud growth. And pretty, I mean, again, a lot of stocks haven't really gone up much since the February highs. So in fact, I would almost say that the average stock hasn't risen much since the February highs. So you have this condition now where the Nasdaq has ridden the backs of, I don't know, is it 7 names, 10 names, 5 names? It's the hyper growth, it's the hyper valued high growth cloud names plus a little bit of FANG, getting drug along. Microsoft, things like that. So the rally, which started as very broad, very wide, and very healthy, has become very thin, very unhealthy, but to put it simply.
All right.
But yeah, I think 300 to 400 off that high of 81.76, that might be enough. I mean, that might be enough. We have to see. I mean, we have new information now. We have trade concerns as opposed to trade, what do you want to call it? We have trade concerns versus trade anxiety. Again, the China deal is probably not as big of a deal. I think I've said this the whole time. Probably not as big of a deal as everybody's made it out to be, both good and bad. There are a few companies that need it. I mean, there are a few companies that will benefit greatly from a China deal in real dollar terms and real business terms. And there's a lot more companies that'll probably benefit. Their stock prices will benefit, but even though the fundamentals won't really change for very much. And then there's a vast array of companies that probably won't benefit, meaning their stock prices, it's probably going to be a big sell the news event for a lot of companies, because there's been a lot of companies that have gone up on China trade optimism a bunch of times, and they literally have nothing to do with China trade. So again, the high flyers. I mean, all the high flyers seem to go higher every time there's China trade optimism. Yet, MongoDB, China's not a big customer for them. I don't know if there's a single cloud software company that actually has material business in China. Because there's probably Chinese competitors, and they've effectively locked out the foreign competition. So I don't really think there's much cloud business being done in China. There might be a little bit. Probably Microsoft or something. Probably has the biggest footprint there, just because there's a big Microsoft installed base. But yeah, we'll see what happens. Like I say, it feels good. It feels good to finally have some shorts at least start working a little bit. That Apple put trade was very nice. I want to reload that at higher prices. It's just nice to see some rationality come back to the market. And again, the last 3-4 weeks, I just felt like I don't have very many things to buy. So that's fine. I've had a huge year already, so I don't really need to do a whole lot except very, very high probability trades until the setup gets better. So, the lower the market goes, the more things come into buy ranges, which means the more active I can get, and it's more fun when you have a lot of names. It's more interesting when you have a lot of names that you can trade, as opposed to looking at the same 5 to 8 beaten up names that you kind of already have enough of. But yeah, we'll see what happens. I mean, there's I don't know where you want to go next, but there's plenty of good quarters that haven't been rewarded. There's been plenty of quarters that have been sort of rewarded too much, but there's plenty of quarters that have been rewarded. 5G continues very good. Qualcomm has a lot of positive things happening. 5G fiber optics looks very good. I haven't seen. I mean, this would be like second, third quarter in a row where I haven't really seen a bad report out of the fiber optic space. Now you might say, well, MTSI has had some bad reports. MTSI needs a trade deal. They're heavily levered to, China vendors. So, and even relative to as bad as their China business is, a lot of their core business for MTSI is chugging along very nicely, and they have plenty of things ramping. They just need, it's tough to hit your numbers when 20% of your sales is effectively blocked. So there's a few companies like that probably smaller mid-cap size chip companies that are inordinately affected by not having the China trade deal done. But it's really, aside from MTSI, it's hard to find 5G/fiber names that haven't reported well. LITE keeps reporting pretty good quarters, and pretty bad guidance, but it's usually it's probably all Apple. It's likely mostly, in fact, maybe all the miss is just Apple iPhone sales not being very good, so therefore 3D sensing sales aren't nearly what they could be for LITE. But Path looks pretty good for them. But that they're probably the one name that has probably been sort of the weaker reporter in that group. And again, it has nothing to do with 5G and fiber optics. It has to do with 3D sensing. It has to do with punk iPhone sales. So the rest of the space is reporting good. So I'll cede the floor, and you can fire away with whatever you want.
Yeah, well, one of the listeners chimed in with a question, and it does regard MTSI regarding a China trade deal, and wants to know if a deal doesn't get done, is MTSI just a flat-out sell?
I don't think so, because I don't think the trade, I don't think their China business, is going to be that much worse than it really is. In fact, once they know what the tariffs are, if they're stuck with them, they'll just have to deal with them and change price. But at least they can start doing business, because an unknown thing becomes known. But that wouldn't be a positive, a long-term positive outcome. Again, I don't think we're gonna live in a world where we're tariffing China products 25 to 50%, though. I think that we'll have to see what the ultimate outcome is. I don't get too worried about threats and tweets and stuff. And by the way, a lot of people, this is not a political statement. A lot of people dislike Trump. A lot of people like him. My view is I think he's one of the few presidents that's attacked the trade negotiations in a way that makes sense for U.S. I think the U.S. for a long time has been way too, I guess, lenient. In other words, we could play hardball with everybody and secure far better trade deals, and that's what he's doing. And on that point, I definitely agree with him. I have no problem saying this. I was more of a Rubio fan. I wanted Rubio to win, but I always judge people based on what they're doing. As far as trade is going, as far as the posture that this administration is taking, I think they're doing the right. I mean, I can't think of another administration, by the way, for 15, 20 years that actually did things in relation to China, which should have been done. Like, why did we allow IP theft for 20 years? Why did we allow super unfair trade deals for 20 years? I mean, there's all sorts of economists and things that could make arguments and say, oh, hey, it grew global economies and this and that. I don't know. We'll see. My view is if you're negotiating from a position of strength, that the U.S. pretty much should negotiate every single trade deal with every single country from. You should extract the trade deal to your advantage. The best trade deal is one where you have mutual advantages. But you shouldn't give another country huge advantages and you sacrifice lots of things just in the hopes that, that country may be a country that might buy U.S. products someday. I think that's been kind of the U.S. trade posture for a long time. I think it's really poor. I think what we're doing now makes a lot more sense. And there's been tons of U.S. companies lost a lot of business and suffered massively from having IP theft stolen and just copycat stuff made out of China or made from China. So that's been a huge problem. It's finally being addressed. I think it's good. And then, China is also a very tough negotiator. They feel like their position is one of power. So you're probably going to have to negotiate pretty tough and pretty hard. So I think that's a good thing. I'm not going to make too much of it what it is. But no, I think once unknowns become knowns, that's usually better, even if the knowns are bad. The worst thing is unknown. And right now, MTSI is just facing a deal where they're dealing with a lot of unknowns. And so, when business is unknown and uncertain, a lot of times it just doesn't get done.
And with regard to China, how does it impact Qualcomm?
I think the best thing that could have happened for Qualcomm related to China is the Apple settlement. Interestingly, it kind of seemed like, and this is just tea leaf reading, it kind of seemed like China was almost sort of backing Qualcomm. I mean, they had a case that they ruled favorably for Qualcomm. They banned some sales of some products, some iPhone products in China. Now they were older products, but still, I mean, they could have sided with China. or I mean, sided with Apple, and they didn't. So I don't know if that's I don't really know if that's the big deal. I would say that the single biggest thing that might help, and Qualcomm had already signed a deal with Huawei, 150 million a quarter, and that's a kind of a placeholder deal. That's not nearly what Huawei should be paying Qualcomm, by the way, and that doesn't account for any of the billions of dollars of catch-up. I mean, China collectively owes Qualcomm about as much money as Apple owed Qualcomm, which is somewhere in the neighborhood of 4.5 to 10 billion. I don't know the exact. Now I don't know if anybody knows the exact number except Qualcomm. I think it's at least $4 billion, if not more. A lot of that owed by Huawei and ZTE, I think, and they may never get that money paid. They may get some of it paid, but at least Huawei's paying them 150 million a quarter now. It's better than zero. I do think Huawei probably formally does a much better negotiation or a much better deal for Qualcomm in light of the Apple settlement. So again, I don't know if there's really much of a trade issue there. I think it's more the Apple settlement is the bigger issue.
All right, and why don't we take a peek at the semiconductors? And this was an interesting one from one of our listeners out there who mentioned 112 and the SMH is a big deal for that level to hold. He wants to know if you agreed. Actually, 112.50. They were talking, or there was a chartist on, I guess maybe CNBC or something last night, talking about that particular level. Do you see that as a key level that needs to hold, or is there something else that you see?
I just think the SOX is another good short. As long as the market's going down, because I've pretty much said the semis are in pretty much the same state as cloud software. So, aside from about three or four semiconductor stocks that I like, I think they're all in my focus list. By the way, I really don't like any of the other ones. I mean, I can't. I have to reach to find another. Well, VICR I like, and VICR is not a focus list stock. But there's a very, very small number of semiconductor stocks I like. I think there's a lot that are prone for the downside. And I mean, frankly, it's just kind of stunning. Whether it's Texas Instruments or ADI, even Intel. Intel did what they should have done. I mean, they took a huge hit on a report. But there's just lots of semiconductor companies that have kind of levitated off, I guess just a higher market, because, again, semiconductor companies shouldn't trade at the same valuation as software, and yet, not a lot of semis are trading like that, but NVIDIA was the first one. Xilinx arguably was trading at still is trading at a software multiple. What's the other one? Cadence Design. It's probably trading at a similar multiple as Xilinx. That's that. In fact, I'm just looking at that right now. That could be a next short. I do.
Which one was that? Xilinx?
Cadence.
Oh, Cadence.
CDNS. I should have been short Xilinx in front of the print because I really, I thought it was a good setup, but I wasn't short it in front of the print. Frankly, I don't think Xilinx has really dropped as much as it should have. Off that print. I mean, they had a pretty good drop, but the stock's still very expensive. It's sort of like NVIDIA, when NVIDIA had the first drop from 300 to 270 or something. 270 wasn't done going down. So, just because its stocks dropped a lot doesn't mean it's going to bounce and go back to where it was. So, I think Xilinx, and I think people sort of misunderstood. Some of the China business actually too was accelerated. So some companies have been hurt by China. Some companies were benefited. There was a lot of talk, and I agree with this talk, that Xilinx was getting a lot of sort of double ordering from China. Again, in other words, they were ordering ahead of trade tariffs that were coming. So, and that's largely done now. So we'll have to kind of see how that plays out and how long of a tail it has. But if a big chunk of their revenue just quits growing, then the revenue assumptions that people built into that model are probably too enthusiastic. But yeah, so just to wrap up on the SOX, I think that you're looking at same thing. It's come in about 100 points. It's had a decent little correction. I don't even know where. I mean, I'm actually kind of struggling to say where I would say like really good support is on this chart. You know, at the same time, I don't know if this is the, like say, I'm not super bearish long term. I'm not. You know, remember all the recessionista talk? I mean, I 100% disagreed with that. We're nowhere close to recession. There was a lot of talk about that the global economic condition was poor. I've been saying this whole year the global economic condition is improving. So, you know, you got to be careful of getting way out over your skis thinking that you know, the conditions for a crash or something exist. I mean, I guess you can always have a crash for an outlier, but from some sort of, you know, revenue production based on economic growth, based on emerging economy growth, based on U.S. growth, et cetera, et cetera, et cetera. I mean, there should be a pretty decent, you know, once we get through this inventory correcting / downturn, which, you know, based on other people's view, hey, we're in quarter 2 of a 5-quarter downturn. There's no exact numbers on things like this, by the way, so I kind of laugh when people say that. I usually say, look, it's usually 12 to 18 months is a semiconductor downturn. And it's fair to say we're about half or 6 months into that. So some downturns are longer, more prolonged. Some downturns are shorter. Some downturns only last 3 quarters. So you know, there are a lot of companies which will see much stronger revenue numbers in a lift. You know, back half of the year, maybe even early half of next year. And then you have another factor. Okay, Apple sales will finally get better in the fall and winter of 2020. So. And in the meantime, how much share is Apple going to lose, and do you see some pickup in Android and so on and so forth? So there's lots of puts and takes to this. But put it this way, I thought 1,066 on the stocks was pretty low. So that was a necessary correction off of 1,400. It was probably too much. So 1066 was probably too low. 1,600 is probably too high. I mean, you could make it real simple, do a 50% Fibbo right in the middle of that. I don't know. I'm looking right now. I don't know if there's a big. I would say last year's highs are probably a good point, or last year's fall highs, 1413, 1406, 1420. I'm actually now kind of looking at the chart I'm looking at. I think 1365 represents. I'd say 1365 to kind of 1400. I think is a natural support zone. And by you know, man, if we went down to 1,400, all of a sudden there'd probably be quite a few semis that I'd want to buy. So, you know, sometimes that happens too. It's just like, it depends how many stocks get individually attractive when indices reach certain levels. So yeah, I don't know. If they said 1250, I don't know if I'd agree with 1250. Doesn't mean we couldn't go there, but I think support's higher than 1250.
All right. Well, I was talking 11250 in the SMH, not the SOX itself.
Well, isn't it the same? Isn't it pretty much the same?
Oh, is it? I don't have the SOX. So.
Well, the SOX 1360 to 1400, I think, is pretty good support. Let me pull up the SMH. I look at the SOX.
I know. I don't have the quote, so.
I guess it's not identical because the high on the SMH is 120. So that same point on the SMH would be 104 to 106 roughly. That would be that same level, that same SOX level I'm looking at.
Okay, so a little ways to go before. So I guess if the listener out there who was talking about this one, a breakdown through 1250 gets you a target in that 106.
I mean, we're there right now. We're at 1250 right now. I mean, you could say, well, yeah, we bounced a little bit, but we're basically there. We're a point off of it. So I mean, we hit that. Other than seeing an EMA there at 1250, it just doesn't really look. Not saying they're wrong. I don't see a natural support point there. You know, on annual charts, I like to use the cloud. Cloud support would be about 105. And that hey, 120 to 105. That's a decent drop. I mean, that's enough. I think that's enough right now, to basically to put a scare in people. I mean, I think that's what this correction ultimately is going to be all about. Is basically it's going to teach a lesson to the people who were over their skis buying stocks they shouldn't have been buying, probably buying too much stuff on margin, probably buying stuff they didn't know anything about. Again, chasing a price. So I think a lot of times you get a correction just because the algorithmic traders that they identify an opportunity set that's just too valuable not to take advantage of. And if you get a bunch of people out of position, sort of like that VIX trade, that was the cause of I think the first big correction last year. It's everybody's on the same side of the boat trade, and right now everybody's on the same side of the boat. You got a bunch of overcrowded and crowded high value longs, and so that's the biggest thing we need to sort of correct. And interestingly, that hasn't happened a whole lot. I mean, the funny thing is, we're having a decent little correction. We're what 175, 200 off of highs now in the Nasdaq. But really, I mean, the cloud stuff, I mean, I think the cloud bulls are probably sitting back going, oh, look at this market selling off, yet my cloud names are not dropping, which means we probably have more downside. That would be my guess.
All right, so let's touch on a couple of names that had some reports that you found interesting, and I'm going to start with VICR. It's not on your focus list yet, but I think it might be, right?
I don't know if I'd ever put. It's probably too small of a market cap to put on my focus list. I don't. Yeah, 1.4 billion. That's probably getting down there a lot, and it's more of a specialty name. But here's the interesting thing. So I'm really like, this is one I really want to correct. They have a little bit of a pullback. I don't know what exact, I tend to kind of know prices kind of when I see them real time. I don't try to overly anticipate like levels too much, but it's 32.50 to 34 would be nice. I mean, something in there would help. So then you have a range, then you use real time action to kind of define an exact level. But let's call another 10% below current level would be nice. Would be at least be nice to look at and say, look, do I want to add this again at 10% below where it is here? Now, interestingly, I wouldn't say their quarter was really that good. The numbers were okay. The commentary was pretty good, but it's with the thing that you and I have talked about, where you get a really good positive reaction on a stock on kind of a muted quarter, or even it wasn't a bad quarter from them. It was definitely a better quarter than the quarter before. But I would just say you had a very positive reaction in the stock on a quarter that really wasn't good. And these guys will have good quarters. I'm pretty surely convinced that they will have a period where they will have pretty good quarters where numbers are good, they're exciting, the beats. I mean, they've done it before, fairly recently. They'll probably have some quarters like that again. So if the stock goes from 30 to 38, and that's pretty much what it did. It went up $8 on just a kind of a benign report, to be honest. So I'm just kind of waiting to what this thing could really do on a good report. And so yeah, I like it. I'd love to buy more. Again, I'd love to see it correct a little bit more. The same thing though, it doesn't really act like it wants to. It was a little bit lower today. By the way, there's some weird spike low. I don't know if that's a real trade or not. If it was, I guess I wish I would have had there was. I showed some flash low to like 33. I guess I should have had a limit order in at 33.
No, I think that's a mistake. I don't.
Yeah,
I don't have that on my
those usually are mistakes. But I don't know. At 36, I just feel there's other stuff for me to buy. I still have some, and I think I intend to keep it because I think there's quite a bit of room to the upside. But yeah, this would be one I liked. But it was definitely an improved quarter. But I think much better quarters are coming. I think they're in a good spot, and you guys have had some good write-ups on the name too. So if somebody wants some sort of nitty-gritty details, I think you can also look to other people that have made comments on it. I'm trying to think of another one. Impinj also, that's PI. That could be a breakout quarter for PI. Now this one hasn't corrected much, and this is where I think the market's kind of right on, because the one thing, typically when you have a clean beat, yes, a clean beat within recent days, those stocks will usually hold the best during a correction, and they deserve to, especially if they're coming from a relatively low level. And pi anywhere from 18 to 20 was pretty cheap. It was absurdly cheap, couple months prior to that. But this is, I think this is their third good quarter in a row, because they had a good quarter late last year. Stock got to like $26 to $28, literally days in front of the market meltdown. So this is a small cap, low liquidity stock. So there's just no way Impinj is going to hold when the market drops 20%. They're going to take a beating, and they did. But then they reported pretty solidly for the first report of the year, and then they just reported another one. I think they had like 29%. I don't know the number. It was either 29 or 30% year-over-year growth. Good commentary. So I don't like chasing stuff, but that one looks pretty good. I mean, that put it this way, that's a move higher that I think is for sure 100% deserved. Another one that I thought, and this stock just to me is back to where it's just not making any sense, is Spotify. I think Spotify had another tremendous quarter, 30% growth. I mean, there's literally cloud stocks that trade 5 to 6x higher multiple that have the same growth that Spotify does. So there you go. I mean, so you can have the same growth of quite a few other companies. I also think Spotify's growth is very durable. And likely more durable than a lot of the cloud stocks trading multiples higher than they are. I mean, Spotify's basically it's a flat out cheap growth stock, and there's not a ton of flat out cheap growth stocks in this market anymore. They're one of them, but you got a big juicy revenue base. The thing I like about Spotify though isn't really purely the numbers. It's kind of just the strategic direction that the company's taking. They're doing, I think, pretty much everything they should be doing to grow the business long term. So it's sort of like, it's almost like kind of feels like a Google with how it's run and how it's managed and their initiatives. It's a different space, but it's just kind of, that's probably the best compare. It's pretty young post IPO, but it gives me that same sense, that same feeling that, when I listened to Google reports and read their numbers and stuff, a year post IPO, I was like, wow, this thing's really cheap growth stock. And, they're kind of doing all the right things. And it's kind of, the Spotify gives me that same view, or that same feeling today. Although I think Spotify is way cheaper. I don't think Google ever traded at 3 times forward sales or anything like that. I mean, Spotify is just, like I say, it's just a flat out cheap growth stock, especially for the growth rate. But yeah, like say Google was probably cheap at 10x forward sales in their younger days. Like I say, I don't think Google ever came close to trading. Even at the bottom of 2009, I'm not sure Google traded 3.5 times forward sales. I don't think they did. So Spotify's dirt cheap.
All right, let's touch on a couple of fiber names. How about ACIA, ACIA?
Yeah, I actually picked some of that up this morning because not so much that, I have a much lower cost than the name. However, I mean, this thing had an $8 drop, just a straight drop. And again, this is it's a stock that seems to love to drop hard when the market corrects. Funny thing though, it tends to bounce pretty good. It's already bounced a little bit today. My guess is if there's further corrective activity, it's possible 5250 holds, but it's also possible Acacia goes lower. But like I say, it was 8 off of the high just 3 days ago. I thought that was pretty good little entry. But 44% growth year over year. I think they're doing all the right things. I think they guided conservatively again. And they didn't really sell off in the report much. I mean, the day after the report, the stock wasn't down much. It's really kind of gone down during these correction days. So, we'll see what happens, but like I say, I like it. I just like this. I believe this is the leadership group. I believe stuff levered to 5G, bandwidth growth, fiber optics, stuff like that. I think that's the new leadership group. I think it's going to replace software leadership. I think in some ways it already has. I mean, Qualcomm's definitely become a market leader. I don't think there's any doubt about that. So I think there's more there's more names that will join the fray. But that's a very good report. And so to be honest, I thought the stock would be down more the day after they reported. They kind of climbed down to where they're only down like about $1 or something. Again, I think their guide's conservative. By the way, they're still basically not getting much, if any, China business at all. They have a big burst of China business coming again at some point. So the beautiful thing about Acacia is the thing that made the stock an expensive stock that I didn't like, which was they were way over levered to one Chinese customer. That's just not an issue anymore for the company. So that was the big bear thesis. The company took care of that thesis just with diversification and winning so many customers across the globe. They're starting to be a bigger data center play now. They're starting to sell discrete products into basically data networks and data centers. So they broaden their user base. I think Acacia has the recipe to become a much larger company. I also think they still have. I don't really think. In fact, they're already talking about 800G and beyond speeds. Most people are kind of excited about 400G as the new thing. I mean, these guys are 800G beyond doing testing on some of that stuff now. So I would say, they a year or two ago, they had a 2-year lead on the rest of the competition. I would still say they have a 2-year lead on the space. So I like it. I think it goes higher. I haven't rejiggered my numbers on it. I don't really think 1 quarter makes that much of a difference. But 44% growth is a fair bit better than they were expecting. So my price target might go up a smidge if I just plugged in new numbers. I don't typically mess with that too much. Maybe if I get 2 or 3 quarters in a row like that, my price target will go up just on numbers increasing. But I think the more important thing is if you look at everything from Qualcomm to Acacia, IIVI had a very good report, by the way. They guided just a smidge lower, but same thing. That's 16% growth year over year. Or what it might have been for. It was either 16 or 14. I could mention stocks that had 14, that had the same growth, as IIVI and didn't guide well, and were up huge, this quarter. So they didn't drop much, but they dropped a little bit. I still think there's a lot of upside once that Finisar deal is completed. But again, I like the quarter. We had Fabrinet report last night. That was a very good report, very strong numbers, good guidance. And then again, we talked about LITE. So I just am not seeing. It's probably the cleanest, strongest reporting area. Again, unless you like, cloud growth, which you can't argue with the growth the cloud names are putting up. The question I have is the price you're paying for that growth. But I don't know. I'd much rather pay 2x sales for companies with a long growth runway, which I don't think are anywhere close to peak growth, than pay 25 to 30x sales for companies that I think are approaching peak growth, if not already have hit peak growth.
All right, and let's close out with a energy name, Bloom Energy, ticker BE. What do you think post earnings now?
In fact, I listened to that report this morning. I think the call is very good. I think the growth runway is very healthy. The stock is kind of doing that beautiful thing that stocks do off lows, where that first move off of lows, even though it's a pretty big percentage move, it's not, I guess, a lot of points. But this kind of reminds me of Micron, when Micron went from being a $9 to $11 stock and then traded for a while between 13, 15, and 16. And the only argument that you really had at the time was, well, geez, it's up 50% off of lows. Can it really go up a whole lot more? Well, we all know what happened. The stock was so ridiculously cheap at 10 that, guess what? Went up 6-bagger, right? I didn't catch that whole ride, but I caught 3 to 4x of it. And Bloom kind of feels like that. The numbers are really good. The growth is strong. But the biggest thing is the growth seems very nascent. It's very early. Yes, it was a private company for a long time. They built a base, but still a relatively small revenue company doing 200 million revenues a quarter. It'll do $1 billion probably next year. But that's probably the thing that I think is not so much the growth rate that they're producing, but I think the durability of the growth. The other thing is just internal metrics, internal financial metrics are improving really fast. So one of the things that I was really bullish on Twitter about much lower prices than everybody else was ignoring. Everybody was looking at things like MAUs and the revenues are kind of flat, but they literally were.
Seems we always hit a stumbling block with TECHT right around the same exact time. It's right before we're about to wrap up too. And there he is calling back in, so let me get him in. Hey TECHT, lost you for a second.
Do you have a timeout on me at 40 minutes or something?
Yeah.
I honestly, I think
I know,
that
we
happened
lose
last
at the
time.
same time.
I literally think we were 40 to 41 minutes in the call, and the call dropped.
Yeah.
Anyway. So anyway, what I was saying is the internal financial metrics on BE are improving. Things like EBITDA, cash flow. Now those are losses, but those are much, much smaller losses. The rate of improvement is very rapid. So this is kind of what I expect. I expect EBITDA, cash flow, eventually free cash flow, things like that, eventually positive earnings to improve at a much faster rate now than revenue growth. And again, what I was saying about Twitter, I don't know if anybody heard. So when one of my bullish theses on Twitter, when it was a much cheaper stock, while the revenues were not growing very fast, cash flow from ops was growing like 85 to 100%. So they kind of crossed that point at which at least the revenue number got high enough, expenses got rationalized, all of a sudden it was producing a ton of free cash flow. And a ton, and I mean, even today, Twitter does almost 50% of total revenues produce cash flow from operations. I don't know if another company actually has that high of a ratio of cash flow to revenue. Now BE doesn't have that yet, and I don't know if they ever will. But the point is, the internal financials are improving very fast now, and I've seen this happen. I've seen when companies go from small losses to small EPS positive. But the free cash flow goes from, or cash from ops basically goes from zero, all of a sudden shoots to like 20, 30, 40, 50 million. These stocks can go up a lot because all of a sudden the internal financial valuation metrics, you can justify a much higher stock price for these things. And this is the same. This would probably be like Spotify in that it's just hard to find really attractively valued growth stocks right now. BE would be another one. I mean, for the growth and the durability, the length of time that their growth likely has, this is very cheap growth stock. So, it took me a while to kind of embrace this. I mean, there are a lot of people kind of liked it when it was higher. I kind of waited for like the third low on this as opposed to like the first low. But this has been a pretty nice name ever since I've been involved. So, I'm a buyer on dips. This is probably one of the easier, but I'm not buying it quite yet. Probably 13.25 to 13.50. I mean, if you were Johnny on the spot this morning, you might have been able to grab it there. It was there for a couple nanoseconds, a couple different times. But yeah, no, I think it's a good buy the dipper. And I think price targets are very, they're literally too rational. I think the high target's 30, average target's 21. That seems pretty low for me, given the financial metrics that are coming through now.
What's your price target?
I don't know if I have a formal one. I mean, I could easily put a 25 to a 30 on it, though. So, I think that. Let me just see where I'd say 25 to 30, somewhere in there. I don't think that's a big stretch. I mean, usually my first target, if you will, is probably my most conservative target. So I don't know. I mean, the stock traded at, it was a LITE IPO for about 5 to 6 weeks, And then the same thing. It kind of, I mean, this thing literally IPO'd, I think, 8 weeks before the top and the fall top in the market. And so, this was a liquidity, tax loss selling, liquidity, lack of liquidity, buyer strike vortex. So, if had that not happened late last year, I don't know if the stock would even be trading where it is now. I mean, if you hadn't had that 20% S&P correction late last year, would BE have ever traded below 18 or 20 bucks? I'm not sure it would have. So, it was a liked IPO. It got to 35. I don't remember anybody saying like BE was a super expensive stock at 30 to 35. But yeah, 25 to 30 is where I am now. We'll see. We'll go forward from there.
All right, Tech T. Well, I think that wraps it up for us for today. We'll have you on next week. We will be somewhat wrapping up earnings season in a way. We'll have a couple of stragglers. Any ones that you're most noting?
Well, this week is still a very busy week. I mean, there's a lot. I mean, MTSI reports tonight again. They pre-announce, so I don't think the current report it really meet. But I mean, LIFT is tonight. LIFT could be pretty exciting. I mean, everybody wants to say that like the LIFT IPO is like this huge disaster. I mean, the stock's not down that much. I mean, it's down a lot if you paid like high 80s for it. But I mean, if you paid low 70s or something, it's not that big of a deal. And I think what we all have found out is that people have been using LIFT as a short LIFT hedge ahead of the Uber IPO. So that's about ready to be done. I think they're gonna have a pretty good report. I really do. I don't know if the stock's gonna go up a whole lot, and here's why. At least in the next day or two. Because Uber's not trading yet. So again, if you have a hedge on to protect yourself against Uber, do you cover the hedge before Uber's trading? I don't think so. So, but once Uber's trading, I think these hedges will be lifted as long as LIFT's numbers are good. And I'd be pretty surprised if the report's not fairly glorious. But yeah, this is still a busy week. I mean, you got Carvana, which is more of a short than a long for me. I'm kind of looking at after the fact. Intercepts tomorrow morning. AOI, I've been warming to it just because it's so beaten up and so cheap. Again, if it goes lower, that's fine. I'll buy more lower. Redfin's tomorrow. There's just a bunch of stuff. I mean, Thursday's a super busy day. I think this is the last of the crazy busy weeks. So then after that, then really it should be kind of like Software Central, really. Splunk reports in like 3-4 weeks. That's around the time Workday reports. All that kind of stuff. So, we'll see what happens.
All right. Well, sounds like we got a lot to talk about next time. So we'll leave it there for now. As always, Sean, thanks for joining us and giving us some updates on your names.
Yeah. Take care.
You too, Sean.
Bye.